Okay, this is exercise 21-25, and it's capital budgeting with uneven cash flows and no income taxes. And remember to reread the piece about what capital budgeting is as opposed to operating budgets. All right, understand that this is part of a long-term plan that's tied to strategy for the company. Okay, so in this case we've got uneven cash flows but no income taxes. And it's considering the purchase of a bottling machine for $65,000 with a useful life of 4 years and no terminal disposal value or salvage value. The plant manager estimates the following savings and operating costs. So they're going to save a different amount each year in operating costs for a total of $88,000. They use a required rate of return of 18% in its capital budgeting decisions. Ignore income taxes in your analysis. Assume all cash flows occur at year end, except for the initial investment amount. Okay? So year end would be an ordinary annuity, but that doesn't help us because we've got uneven cash flows here. You can only use that when the cash flows are the same. So America Cola uses a required rate of return of 18% in its capital budgeting decisions. Okay, I just did that, sorry. Calculate the following for the special purpose bottling machine. So we've got to do net present value, payback, discounted payback, IRR, using interpolation, accrual accounting rate of return, okay, based on the initial net investment, which means not the average, okay, and then assuming straight line depreciation, use the average annual savings and operating costs when computing the numerator, whatever. So we'll get there. So the net present value is first. Okay, and here are our cash flows. What we've got to do, and I think you probably know this, but you've got to multiply it times the present value factor for each year. So at the end of 1 year, for the lump sum, you know, the present value of a lump is 0.847, and here's 2 years. Okay, so in 2 years from now, we'll get 22,000, so the factor would be 0.718, etc. Okay, 0.609, 0.516. So after 4 years, say 4 years at what's the rate? 18% cost of capital. It's just about worth half as much, which is amazing. So here is our total cash inflows. That's a reduction of expense. It'll cost us $65,000 to get there. So the net present value is negative $49.20, and the project would not be worth it. Okay. Now payback is okay, remember that all we're doing is we're going to go until it pays for itself, and then we're done. Okay, and the part you want to pay attention to in here are those stupid prior, partial years, so just get it straight in your head and you're all set. So we've got an initial investment, you know what, these are all going the wrong way, aren't they? Initial investment of $65,000, and that is cash going out the door. This is the kind of mistake I make. And it's a big mistake because you can end up thinking a project is worthwhile when it isn't. Okay, so $65,000 out the door. Then we save $25,000 in operating costs. Yep. And then we've got $22,000. Now there's only $18,000 left, and our next savings is $21,000. Okay, so the payback period is 2 years. Okay, plus 18 over 21% like of a year. That's how to think about it. So, let's see, what do we have here? Oh, 18 is our balance. So, we would get 0.86 way through the year, and we would break even. So the break-even point is 2.86 years. Okay, so there's a little wrinkle in it, but it's not so bad. It's not you just have to do one problem to get it refreshed in your head. Okay. Now here is a ratty old piece of paper. I don't know what happened to it. But this is the discounted payback. Now we haven't done this before. But here are our periods, and we've got $65,000 going out. And for my first year, I've got $25,000 times the discount rate of 1 year. Having to wait 1 year for the money is worth 21,175. So now our running balance is 65 minus 21,175. Okay? I think that works. Then we've got another savings of 22,000 times 0.0718 is really worth 15,796. So now we're down to 28,029. Then savings of 21,000 times 0.0609 is a discounted savings of 12.709. See, and that makes a big difference. This 21,000 on a regular payback basis without, incorporating the cost of funds, time value of money, it's really worth 12,789. So that's a really big, significant difference. So now we're down to 15,240. Now we've got another payment of 20,000. Our last savings of 20,000. So that's worth an inflow of 320,000, and it's still negative. So we would conclude that the project was not worth the investment. And the problem is this discount rate, okay? That's what's doing it. Yeah. Okay, now internal rate of return. Just plain old internal rate of return. Oh dear. You know what? I have one of these for you, but I don't have it done in here. So I'll come back to this one, okay? It's not going to be on the exam because it's too time consuming, and personally I don't see the value in it. Who in their right mind would interpolate this if you had a calculator, okay? So the last one is the average annual savings, accrual accounting rate of return. And the average annual savings is 88,000. All right, that's what they said to use. 88,000 divided by 4 years is 22,000 a year. All right, and our depreciation with no salvage value would be 16,250 a year. All right, so the accrual accounting rate of return would be the savings of 22,000 minus depreciation. This is more like an accounting. Yeah, this is a decrease in expense. That's an increase in expense. So this is more like an accounting, like an income statement, okay? Divided by the net investment. Okay, it gives us 5750. Our accrual accounting rate of return is 8.85. Okay, I do have an interpolation one for you if you're just dying to know, but I wouldn't spend too much time on it. But you might want to know it just so it's not a blank spot in your head, You knew it at one time. Okay,